When it comes to commercial real estate, what you earn is important, but what you keep, that's what really counts. And that's where smart tax planning and financial strategy come in. And in this session, we're focusing on the financial fundamentals that often go overlooked. Understanding the tax implications of property investment in the UK, and building a long-term financial plan that keeps your goals and your returns on track. From income tax to capital gains, allowable expenses to efficient structuring, knowing how to navigate the financial side of your investments can mean the difference between just getting by and truly building wealth. Let's break it down and set you up for success, both now and in the years to come. Let's start with tax implications for investors. In the UK, commercial real estate investors deal with a unique set of tax responsibilities, and being aware of them upfront helps you structure your investments more efficiently. First up, we've got stamp duty land tax, SDLT. When you purchase a commercial property in England or Northern Ireland, SDLT is applied on a tiered basis. The good news is that commercial properties generally have lower SDLT rates compared to residential ones, but the costs can still add up, especially for higher value transactions. Then there's VAT, value added tax. Unlike residential property, commercial property transactions can be subject to VAT, typically at 20%. However, this depends on whether the property is opted to tax. That means if the seller has elected to charge VAT on the building, you'll need to pay it, unless you can claim it back, which you often can if you're registered for VAT and using the property for taxable business purposes. Next, we have corporation tax. If you're investing through a company, which many commercial investors do, your rental income and capital gains are taxed under corporation tax rules, currently at 25%. The advantage: you can often deduct a wide range of expenses, from loan interest to maintenance costs. And let's not forget capital gains tax, CGT. When you eventually sell your property and make a profit, you'll likely face CGT. The rate and rules differ depending on whether you're investing as an individual or a company, and whether any reliefs apply, such as business asset disposal relief or rollover relief. So what's the takeaway? Don't just look at the purchase price and rental yield, always factor in the tax implications. Better yet, work with a tax advisor who understands commercial property, because smart tax structuring can dramatically improve your bottom line. Now onto financial planning for long-term success. It's easy to focus on short-term wins, finding a great deal, signing tenants, or watching your property value go up. But successful investors always keep their eyes on the long game. And that starts with a solid financial plan. First, create a realistic budget. This should include not just acquisition costs, but also ongoing expenses, maintenance, insurance, management fees, vacancy periods, and of course, tax. Leave room for the unexpected, because property ownership always comes with surprises. Next, build in financial buffers. One of the best ways to weather downturns is to maintain strong cash reserves. Whether it's for emergency repairs or covering mortgage payments when a tenant leaves, that cushion can be a lifesaver. Now, think about debt structuring. Not all debt is bad. In fact, leverage is one of the key advantages in property investment. But it needs to be sustainable. Know your loan terms, interest rate exposure, and what happens if interest rates rise. Having fixed-rate options or interest coverage ratios can protect your cash flow. Then we have exit planning. Yes, even at the beginning, you should be thinking about the end. Are you buying to hold long-term, or do you want to sell within 5 years? Will the market conditions support that? What tax will you pay on exit? Thinking ahead keeps you from being boxed into a corner when it's time to move on. And finally, consider how your commercial property fits into your broader financial goals. Are you aiming to supplement retirement income? Create a legacy for your children. Fund a business venture. Property is just one part of your portfolio, and the clearer you are on your bigger picture, the smarter your decisions will be. To sum it up, while taxation and financial planning might not grab headlines, they are critical components of a solid investment strategy. Taking the time to understand your financial obligations and plan ahead isn't just about staying compliant, it's about making informed decisions that support your long-term goals. When you've got a clear handle on the numbers, you're not only protecting your investments, but giving yourself the peace of mind to grow with confidence. In our next episode, we'll dive into one of the most important trends shaping the future of commercial real estate: sustainability and ESG. You won't want to miss it, and this is Eggs Invest, where smart investing begins with smarter insight.